In this morning's U.S. Bank Economic 360, there's been nonstop speculation about what the Fed is likely to do about interest rates in the second half of this year. The Federal Reserve normally controls only short-term interest rates, but in recent years has engaged in a program to keep longer-term interest rates low. There's a lot of talk about this program being tapered in the months ahead. Tapering is a big issue for the capital markets. For insight on what is ahead, we turn, as we do each week, to U.S. Bank senior equity strategist Jim Russell. Jim, we know that the Fed has controlled short-term rates. How will it control long-term interest rates?
Good morning, Brian. This is a fairly complicated topic, but a fancy word called quantitative easing has been in play for maybe 3 or 4 years now, where the Fed goes in and buys Treasury bonds and mortgage-backed security bonds from the open market and just holds them. That has brought interest rates down by about 60 basis points, or 0.6%, where otherwise interest rates would be a bit higher. So the Fed has actually played a very, very constructive role in the economic recovery. No, it's weak. No, unemployment remains a little bit on the high side, but this is one of the things that's really primarily responsible for the housing market recovering, as well as interest rates remaining low, corporations being able to refinance, consumers able to refinance. So this has had a pretty big influence on the economy. Now, let me also quickly add that in recent months, there's been a lot of talk about this program starting to perhaps be toned down a little bit, or the tapering that you talked about, and interest rates, even on the anticipation of this being tapered, are starting to rise again.
Well, they're bound to rise. I mean, I can remember a time in the 80s when they were double digit.
Right.
I remember paying 21% interest on a business loan. We've had almost no interest rate lately. So they're going to go up. What will that impact be on all of us as consumers and on business?
Well, unfortunately, it's going to increase the cost of money. Interest rates will go up for homeowners, for business owners, as you mentioned, consumers as well. We have a graphic here on just maybe where those interest rates may be headed. You can see on January 1st, interest rates were in about the 1 3/4 range, and you can see that they're at 2.41 currently. In the interest rate circles, that's a fairly big increase in interest rates, about 65 basis points, or again 0.65 or so in terms of the increase. You can see where mortgage rates, maybe more to the consumer's point, recently 3.15. Again, if the Fed stops the program, we do anticipate interest rates to back up 0.6%, perhaps taking mortgage rates to 3.75. That increase alone would increase the cost of a mortgage for a $100,000 house, a little bit over $400 a year. So again, the times they are changing. To your point, interest rates have already seen their low, are starting to renormalize as we move forward.
It's a big deal. How much do you think they're going to be going up in the next few months?
Yeah, that's a great question. It's anybody's guess, candidly. But what we have is a graph here that really shows you again where rates were in January 1st, where they are currently. We do think that interest rates are headed higher over time. Not dramatically so, but we do think that the trend is up.
All right, Jim, thank you. We appreciate you and, of course, U.S. Bank.
Yes, sir.